Hello, everybody, and thank you to the Milken Institute for having me. This is a blockbuster panel. The who's who of real estate is on stage, and we'll have time for 2 or 3 questions from the ground a little later. But I know there's a lot of money in the room, so I'm going to jump straight into things, all right? AI keeps many C-suite leaders up at night. It certainly has represented sort of a grenade in the news industry. Some might say it's removed the gatekeeping functions of legacy newsmakers. And I'm just wondering, we know this is a long-dated asset, but how is AI impacting your investing lens? Shall we take it down from there? Kishore, can you kick us off?
Sure, absolutely. Morning. Look, I think the world of real estate is changing from what I'd call the visible to the invisible, right? So it's the values today and everything we can't see that we use. The cloud, as we like calling it, lives in a data center, right? It doesn't live up there. So I think that's what's driving value shift, and that's what's driving demand. And AI is obviously a big part of it in terms of compute power, but let's not forget what sort of makes that and enables that is the access to power, the access to fiber, connectivity, and that's critical. We'll see what that does longer term to other forms of real estate, office in particular. We've seen that sort of shake out in some parts of the world. I'm not sure if it's totally dead, but certainly for the foreseeable future, it's much more about the less visible parts of real estate.
Yeah, I like that analogy.
Yeah, I mean, I think AI, obviously, AI is real. We can't ignore AI. AI is changing the way we live, work, and play. And if you look back at how that translates into real estate, right? Because where we work, live, and play is all real estate related. So how does AI relate that behavior change? How does that create opportunities and also challenges? Obviously, as Kishore just mentioned, office is going to have to be rethink. Companies, maybe every 3 analysts you have to hire will now be 1. The AI native, people who grew up with AI will actually displace some of the workforce. So some more senior guys who actually can't re-educate themselves into AI. Adult re-education is going to be an interesting asset class where we have even done it ourselves, where we're turning empty offices, distress in London into schools, right, for re-education. That's a niche sector that could be a play. But on the broader theme, AI is going to be somewhat disruptive to the office because floor space companies need that are adopting AI will be reduced. So it's yet to be shaken out how that is. So there's displacement. But when there's displacement of that sort, there are opportunities. Right? AI companies that are creating products to displace jobs have to create those products in their own cool offices, right? So something we have been doing quite actively of late is investing into areas that people are writing off, like San Francisco, Seattle, Bellevue, because these are the hotbeds of where the AI talents are and where companies are creating those products. So that's negative and positive. And then in the longer term, if you believe AI is going to make all of us more efficient, make companies more profitable, or certain companies who can adopt AI more profitable, then the owners, shareholders of those companies will actually have more money. While they have more time, they have more money, maybe widening wealth gap for that matter from a social problem point of view, but more money to people who have also more time on their hand because robots are going to start waking you up in the morning, giving you your vitamins and medicines, doing a lot of that. So you have more time, you have more money. That's going to benefit luxury residential, potentially luxury second homes, highly experiential hospitality, and probably highly experiential retail for that matter, right? So you're seeing some of that shift. You're seeing some of these are very long-term thinking family offices investing in impossible to replace high-end retail, impossible to replace high-end resorts, and so on and so forth. So it's still to be shaken out, but there are interesting shifting landscape, even as we convert what you can't see to what you can see, and what you can feel, and how you can work, play, and live.
Yeah, good morning, everyone. Sometimes I think for real estate, it is all about increasing value or preserving value, or making sure that values appreciate. But for AI, it's something that we need to embrace, but then do we have a long-term view or do we have a shorter-term view? Because when will the value be realized for if we adopt AI? So AI is more than just perhaps a loss of jobs. AI could be in many, many sectors, from prop tech to all kinds of digital technology. And how would it then improve real estate operation, not just in terms of manpower? The other thing that is quite concerning would be, we all know the phrase, rubbish in, rubbish out. So if you do not monitor AI and you do not have the checks and balances for AI, then we could be at risk of making also wrong decisions where our portfolio management is concerned. So that's my view. We can't ignore, but we should embrace it cautiously and embrace it well.
Does it keep you up at night, Stuart, or are you seeing more opportunities?
No, I'm excited. I think technology, I often say to people, I think probably the last 5 or 10 years in real estate globally has been far more fascinating than before. And two reasons. One is obviously technology impacts every sector, both good and bad. And two, I think you can take a lot of confidence that global trends are sort of spreading out into different markets, and what is happening maybe in some of the more mature Western markets as internet adoption and handphone usage and things like that start to come into some of the Asian markets, that the trends for particularly operating real estate will occur as well. So, in our world at JLL, we're seeing a portfolio sort of reallocation, people coming out of traditional sectors into what we used to call alternatives, although many of them are not alternatives. And a big part of that is data centers, of course, and now battery storage and infrastructure that's associated with that. I think probably the biggest question mark for the real estate community is there enough capital? At the moment, there's enough development capital, both debt and equity, for this huge surge in data center demand, but is there enough what I would call core capital for data centers, either in the listed or the unlisted market? And so there's many of the real estate community grappling with that at the moment. I think technology generally just provides much better access. So we're seeing a real explosion in private wealth that is accessing real estate. We're seeing technology aid the living sector. A big theme across particularly the Asian markets is build to rent. And part of that is affordability, part of it is just in urbanization and demographics, but part of it is technology just allows greater access, and that's already happened obviously in the retail sector. So every sector, technology and AI is playing a crucial role.
I want to look at capital flows now. So cross-border real estate investment in Asia-Pacific up 13% in the first half of this year, driven by South Korean office deals and investment in data centers. What are you seeing in terms of capital flows in the region?
Data center is still a tiny proportion. I think on our JLL numbers, it's probably less than 2 or 3%, but that will change, I'm sure, in the next 10 years. Volumes up. They're actually up across the world. Asia has been far more resilient. If you look at just the ups and downs since COVID, Asia has been far more resilient than the US particularly, and it's been resilient in the traditional sectors. So still, I think across the region, office equates for around 40 or 50% of all deals. There's been more deals done over, say, $200 million in office in Asia than the rest of the world combined. So that demonstrates, again, just this underlying demand. And I think why people are coming back to the market is there's much more confidence in where rates are. There's been cuts across the world, but probably most particularly there's growing confidence in the underlying fundamentals, and there's a huge pool of domestic capital. So Korea is a great example. Japan's the other. I think more than 50% of all deals in the last 12 months have been done in Korea and Japan, partly because of rates, but now what we're starting to see in Japan is there's really strong underlying rental growth. And I think as we move forward in the next 12 or 18 months, that is really the critical element, is that there has been no supply in many of the real estate sectors delivered, not only in Asia, but across the world. So really good real estate and the rents that you're getting from that are going to accelerate because the cost to deliver supply has grown significantly, and the financing around that. So I think there's growing confidence across the world.
Well, speaking of confidence, Goodwin, you're raising a new $2 billion fund. is targeting high-risk, high-return strategies. Are you leaning towards specific geographies or particular asset classes?
Hopefully not high risk, and fundraising is not easy these days. And obviously real estate don't generate the returns or excitement versus AI, venture, biotech, and private credit for that matter. So, but when there's so many negative factors, there are obviously clearly a lot of opportunities. As I alluded to earlier, if you want to generate value-add returns and relatively lower risk, then you have to look for the big themes, right? The big themes is really geopolitics, that's one. But what does that mean? Geopolitics means is globalization going to be, whether you call it deglobalization or actually regionalization, that means supply chain lines are going to be redrawn. That's a big opportunity from the geopolitics. And obviously China, Made in China 2025 has always been about looking back at history. Any nation that actually propelled themselves to the top of the world in terms of being a manufacturing powerhouse will actually rise in the world order. And China's tendency has largely to do with its manufacturing prowess. And it's very difficult to redraw that whole supply chain, right? Even if Apple can go open a big center in India to assemble iPhones, assemble Macintosh laptops, they even down to little screws, every little one of those parts have to be made by some specialists in China in the whole supply chain. And those supply chains in China are all in the different villages, different cities, where the skills are concentrated. So that redrawing, regionalization of the supply chain will create opportunities. In Asia-Pac, I think that one of the biggest beneficiaries we have seen has been Vietnam, right? Which is, we have been building 20, 30 million square feet almost every year in northern Vietnam of ready-built factories, renting to manufacturers from China and the rest of the world, looking to actually just move the assembly plant across the border from China, southern China, into northern Vietnam, right? To say this is made in Vietnam. And then at the same token, we see those Chinese manufacturers who have clients, who have supply chain, who knows where to ship their products, opening in Mexico and opening in Turkey. Right? These three places, I think, will be a very big beneficiary of China plus one. Right? Turkey for European, for EU, for emerging Africa, and for Central Asia, that region. Mexico, obviously, for US, and then Vietnam for China, China plus one, plus the rest of the world. Right? So that's a big theme on geopolitics side. The other is obviously distress. Real estate has been an unloved asset class for quite a few years now. After COVID, then you have the significant spike in interest rate as a counteract to the inflation induced by logistics bottleneck of COVID. And when that spike in rates, all of a sudden real estate, all the calculus are wrong, right? When you were financing your assets in the low 2% range, and all of a sudden you're paying 8% in many cases, no matter how prudent you are, how much value you have created, it's got wiped out by that reset of the cap rate. And when you look at that, it's ugly, but that also creates opportunities, right? Because obviously you have work from home on the office sector, you have AI taking jobs away potentially in the future. So office is hated across the board. And when the whole asset class is simply write off like that, which happens to be the largest asset class in all of real estate, which is office, you do find opportunities because, as I mentioned earlier, right, AI companies need to be created somewhere along the line. And they happen to be, if you are creating an AI product to displace jobs, you're going to be creating out of the Bay Area, out of Seattle, out of Bellevue, and those areas happen to be where people are writing off left and right. So that's interesting, but obviously it's hard to raise money on sectors so unloved. But if you have the bravery to actually go into those sectors, you'll be rewarded. No different than I remember exactly this is how when I started in the business in 1995, was when there's everywhere that you can buy where there's absolutely no capital available, especially institutional capital, it's where actually you'll make a killing in a very short period of time. Right? That's how wealth are made. And then...
Are you still buying in China then?
I am... So maybe this will be my last point. My last point is I am still buying in China, probably mainly in data center and logistics. We've been very careful. We've been much more active on private credit. But I think China now includes Hong Kong. And when you look at that point of view, These days, more and more of our LPs, and I think, Stuart, you're hearing from investors saying, how do we actually diversify from not just be US dollar-centric investor? We're too concentrated in US alone. And if you look at that, you say, okay, you have to play China, which is the second largest economy. Where's the easiest place to play China? It's a Hong Kong recovery, right? Because Hong Kong operates under a different set of rules. It's a tax haven coupled with a money center, tied in together with the global Bay Area now, which is what, number 10 economy in the world by itself, larger than California. You look at all that, you say, Hong Kong has been actually on a 15-year low point. It's no coincidence that Alibaba, the leak rumor of Alibaba buying a pretty chunky building, part of a building for almost $1 billion. And I have intel to tell me somewhere in the next 4 weeks, there'll be another 2 very large Chinese tech companies buying asset in Hong Kong to announce that this is the presence. In Hong Kong, we know, historically, Hong Kong used to have to compete with Shanghai because Shanghai is not a stepchild as China sees Hong Kong as for a long time. So there's always competition. There's no more competition, right? China say, Hong Kong, you are now the window to the world, and for the world to do business with China is through Hong Kong. So I think China will be probably the first to recover as investors start looking to go back into China. From a real estate point of view.
Stuart pipped me to the China section there. So I'll just rewind a little and pick up on the theme of geopolitics. I understand at the recent ASEAN economic ministers meeting, a concern ministers were repeatedly raising with a wave of protests across Asia. I'm thinking of Nepal, Indonesia, Gen Z, young protesters wanting economic inclusion. Do you think, Kishore, that these protests have or this trend towards wanting more transparency and accountability could impact property prices throughout the region, either in the form of governments taking measures to support these markets or protests pushing them down?
It's an interesting question. Look, I think it's hard to disconnect real estate from geopolitics, and that's probably even more so true today in the world we live in than it ever has been. But if you look at sort of the reasons and the drivers for some of those, I think it in many ways does come back to where we started this conversation around tech and AI and job creation for young people. I think it's a frustration with that. I'm sure some part of that is frustration with probably bad governance. And to that extent, I would say the positive view of how to solve that is no better place than the city we sit in, right? If you look at sort of just housing being one problem, there's no place that's done that better than Singapore in terms of what we've created with HDB and things like that. So I think if you get governments that can kind of think forward around those dynamics and be thoughtful, have right people in there, be relatively non-corrupt, which is kind of challenging these days, then I think you can kind of try to solve for some of that. But outside of that, I'd say more broadly, prices are going to be connected to geopolitics. And to that extent, you're seeing those flows of capital either into trends around data centers driving AI, into countries which, there's a lot of reasons why capital goes into Japan and Korea, but it seemed to be more stable than many other places. Into places like India more recently, just given the tailwinds around the growth. So I think geopolitics and asset value is very hard to disconnect them. To the same extent, I think you see for the first time, and certainly many of us can remember in our careers, investors are now allocating a risk premium to investing in the US, which historically you never thought about it that way, right? And so that's, again, the politics, the geopolitics of it.
You had a thought?
Yeah, just a thing that maybe the audience could also give some feedback is, would the younger people still be wanting to think that real estate is a way to wealth, long-term wealth? Traditionally, we have been very brought up, especially in Asia, to think that, if when you're rich or when you are able to, you should accumulate property. But the younger generation with AI and everything, they may not think that property is the only way that you could kind of grow wealth or ride out inflation. There's just so many other things that they could be, other alternative investments that they could be investing in, which are a lot more liquid compared to real estate, where there's laws, regulations, there are ways, there are times when monies can be repatriated out from the country. So, does this political uncertainty signal anything that we should give greater thought to, or just go on at the traditional path of investing in real estate?
Well, speaking of alternatives, they ranked the least favored in a Morgan Stanley survey, and debt was among the top favored. How does that impact your investment strategy, Kishore?
Yeah, look, I think in real estate, and Goodwin touched on it, I think we've always looked at, again, real estate, if you look at sort of data centers as an example, as I said, visible versus invisible. The other thing that's visible versus invisible in real estate is debt, right? So if you look at a typical hotel, office building, 60-70% of the total capital that goes in, sometimes more, is in debt. And that's generally been, that's typically in Asia, certainly resided almost entirely with the banks. Of course, it's lower return, but needless to say, it's much safer when you have volatility in underlying real estate values. And I think increasingly with private credit, what is coming to bear is the access to that to other sources of capital, whether it be retail, whether it be wealth, whether it be institutions, because they're saying, look, I can, on one end, I'm happy to own a building, but I've seen that prices can go up and down, when trends happen in a more volatile fashion than if I own the debt of that. On the debt side, if you look at the largest component of real estate globally is residential, right? And that residential real estate mortgages as an asset class in the US, you trade $350 billion of mortgages on a daily basis, right? Because they're securitized. In Asia, all of that sits with the banks. Will that come to bear, and should institutions and individuals not own a piece of that in some way when they're happy owning hundreds of billions of dollars in REITs, which give you a sort of an attractive yield dynamic? I think we'll see a lot more of that innovation coming to bear in our markets.
I know you're passionate about REITs. We talked about this in the prep call. It's hard to believe that it just appeared here in Singapore about 20 years ago. It was Capital Mall Trust that was the first REIT to list in our market here. I wonder, in terms of financial creativity, are there any new innovations coming to the market now that you think could catch fire?
I think you're seeing a fair bit come through on the private credit side. I think you've had a lot of U.S. funds bring sort of debt and private REIT products to the Asian customer. The thing has been, and they've resonated well, but they've largely been U.S. dollar denominated and focused on underlying assets in the U.S. There's no reason we shouldn't see that happening in our markets, where local currency products. I mean, again, we take REITs as an example. There's hundreds of billions of dollars of that where individuals and institutions are buying for a 5-6% yield in Singapore every day. And if you gave them something similar, maybe even something a little bit lower with underlying, residential or commercial debt, that there's no reason that should not resonate, especially if it was local currency. As you see demographic trends driving sort of return generation on the large pools of retirement capital here and everywhere else, they need more consistent yield generating, income generating products in their portfolio than sort of higher risk stuff.
Michelle, also another thing is in Singapore, for example, there are examples of tokenization, fractionalization. It's similar to REITs, but perhaps not in the listed sphere, and in terms of transparency, it could be different. But if you create such alternative tokenization or fractionalization projects, but give it the same veneer of transparency, give it the same kind and look and feel of corporate governance, say, for example, of REITs, this could be something that investors may, be very keen to look at, because they may not be able to afford an entire shopping center, but if you tokenize it or fractionalize it into 1,000 units, and then people can just buy it like a REIT, but just that it's not listed. The downside is because it's not listed, then where's the exit strategy? Do you have to wait for some time? So if you can get around some of these kind of roadblocks and then put a real proper package around it, I think that could be an example. That could be a quite an attractive alternative too.
Yeah, Sulan, good point, right? I think tokenization is going to be an interesting. It's people who understand REIT will say it's no different than REIT, but the difference is essentially you can, because the cost of launching it through the blockchain will be so low and so transparent that you can divide it in very small units, and potentially you can even put them on the crypto exchange, or even on low-cost brokerage like a Robinhood and the likes to sell. But obviously, I think the early deals will have to be something more iconic, right? Whether it's like a Raffles Hotel in Singapore or something of that nature that you can have thousands of little investors who say, hey, I'm protected by the blockchain. I know I get this amount of income stream per year. Maybe I even get some benefits as being a shareholder of that hotel when I go there, when I book a restaurant and the likes. You can actually all put that onto a blockchain and sell that. The key is, it's no different than the treasury companies being launched in the US. For example, the famous one being MicroStrategy that actually own a lot of BTC. People are saying, why is MicroStrategy, now called Strategy, why is that stock price trading at higher than the underlying value of the Bitcoin? And that's purely because they figure out that they are the easier on-ramp for daily retail equity investor who doesn't want to go through the hassle to buy Bitcoin and put it into a wallet and go to an exchange to buy Bitcoin. They can buy it easily through the Robinhood stock account they have to get onto Strategy. But it's no different. So is there a universe out there with the younger investor who are comfortable trading Bitcoin, comfortable trading crypto, to say, hey, I wouldn't mind being a small shareholder of an iconic asset in the city that I actually live? And that can be something quite innovative to come.
Are you positioning at all for fractional real estate or this whole area of opening access to the small guy?
It's already in Singapore in some of the companies that have started out, real estate companies. And like what Goodwin mentioned, maybe they do not have iconic products or assets. So it's successful, but I think they could achieve greater success if you have a really iconic building. And like the point that I mentioned about the younger people, maybe when they have money, do they want to buy traditional real estate where it takes a long time to sell and to buy, and the stamp duties are hefty? And maybe these are the things that they can, in the future ahead, these are the kind of products that are real estate and yet financial related, a good hybrid, which could be considered.
Okay, just continuing on the theme of the seen and the unseen, where are refinancing conditions tightest now in Asia? Stuart, can you give us a sense?
Yeah, well, Asia, the banking system, both in traditional relationship banks and private credit, has been pretty liquid. So there hasn't been maybe the distress through the CMBS market that you'll see in the US, for example. But there is a few pockets of illiquidity. And China, particularly if you're trying to refinance offshore, is tremendously difficult. And many of the foreign-owned assets are, of course, sort of with an onshore-offshore structure, so that offshore component is very tough. I think Hong Kong financing is tough, just given the decrease in real estate values. And then Korea is a place where the market's actually really, really strong, but just in the development of particularly logistics, there's sort of a gap in that funding market. But as the panelists said, there's a lot of private credit around that's seeking those opportunities. So generally, the debt conditions around Asia Pacific are very liquid.
I would say, if I could add to that, I don't think it's quite deeply challenging yet, but I think the banks are certainly challenged around their data center exposures. Given the sheer volume and quantum of the build that's going in, what it costs to put that capacity in place, I think increasingly the banks are starting to feel a little bit strained. So Stuart made the point earlier, can we find offtake for existing stabilized assets into REITs or other capital pools? I think that'll be a big driver, because otherwise a lot of that is held, with good underlying credit and offtake from hyperscale customers, but a lot of that is held on bank balance sheets in big size.
But I think what's been great for global, but particularly Asian real estate markets, is the liquidity in the Asian banking system and the cross-border propensity now. So Japanese banks going offshore, MUFG have been doing a lot of data centers in the US and in Johor. Singapore banks are very active. So not only are real estate investors on the equity side going offshore and cross-border more easily, so are the banks. And I think, again, that's just a function of growing pools of capital. So that's been great for the markets.
Are office rents still coming under pressure across the region, or have they stabilized?
Well, you used to be able to sort of talk about Asia Pacific in one line. It was either going up or down. I think the markets are all very nuanced, and of course it relates to demand and supply. But there's a few markets that are challenged and are still below sort of 2019 or peak levels, and Hong Kong rents have probably come off 35-40%. I would think that they're still going down. Some Greater China markets have come off 50%, and they're probably still going down. They're the exceptions. Melbourne is another place where there's a large public sector occupancy proportion. That office market is challenged. Everywhere else is going up, and I think particularly in Sydney, we're probably seeing a trough. Here, we've got really good confidence that rents are going up. And Tokyo, probably for the first time in 12 or 14 years, we're seeing really strong reversion, sort of up to 10-15% in some of the rental renewals that are happening. So I think that's the story really for the next 12 or 18 months. Previously, it's been an interest rate cap rate spread. Everyone would talk about positive spreads and negative spreads, but now it's about focusing on the income side of the equation. And both value add and growth investors are looking at that, and then the stability of the income, as Kishore said. A huge amount of insurance, retirement savings, 401k savings that is going to happen out of the US, looking for stability around income. But generally, I think the office markets in Asia Pacific are in good shape.
Is logistics still a capital magnet? In which markets, India, Southeast Asia, Korea, offer the best risk-adjusted returns today?
I would say India, but I'm happy for that.
Anybody want to?
It's still in demand, right? Especially if you think about the redrawing of the supply chain. That by itself is creating demand in certain places where it didn't have the manufacturing hub previously, getting factories, and also in places where you have a rising middle class, more and more of the consumption is driven to e-commerce, and that necessitate space from retail side going back into warehouses, and so on and so forth. And then logistics also, in a way, include industrial real estate, right? In some of these places where you do have an increase in manufacturing capacity or demand, then you actually drive demand for industrial properties as well as logistics. So I think Malaysia, Vietnam is going to still have a lot of demand. China is one sector where investors like us have been able to build, rent, and sell logistics assets with pretty good margin, right? We've been selling a lot of our warehouses to the Chinese insurance companies hungry for yield. But in China, ultimately, there's still a lot of savings. A lot of that savings are in banks, in pension funds, and they all are in insurance companies, and they're all very hungry for yield. So they are chasing yield because they see logistics as being a more stabilized asset class and still continue to grow. So demand is still there.
Michelle, I just wanted to go back to the office sector. Sure. With AI and the kind of jobs that's going to be created in future, maybe just a food for thought for the audience is, would the young people or the industries of the future still want to, the workers, do they want to work in CBD kind of tall, high-rise, Wall Street, Hong Kong, or Singapore kind of tall buildings? Or would they prefer a kind of a campus-like kind of an office where essentially it's a tall building, but probably you put it on its side? And is it something that is more kind of suitable for the young in future? Would they prefer those, or would they still want to go to the traditional office that in a CBD that we are always thinking of? as a best place to work in? So I mean, just
Yeah, I think that's a good question, I feel that that question's nearly been answered. That through COVID, everyone talked about hub and spoke, that you would only come into the office occasionally, and that you would work in a business park environment. I think that's been proved to be incorrect. Actually, people are gravitating back to city centres. They want to go to the theatre. They want to go to restaurants. They want to be in a lively, and so you're starting to see. New York and London and Sydney, the life coming back to these markets, and actually it's the business parks that are suffering.
Yeah, Stuart, it may affect your business a little bit. I saw an agentic AI product. Pretty cool. It's an agent where we typed in a criteria. We said we're a company with an age group, opening an office in Tokyo with an age group of 25 to 38, tech-centric company, for a Tokyo branch, and then where would be the suitable places for an office. In about 21 minutes, right, this was agentic AI, so it was comparing its answer to see whether the answer is smart enough or not, going out, plugging the APIs, putting information out. 21 minutes, came back with an answer, 14-page report that would have taken 2 analysts 10 days, 2 weeks of a JOL to create that report to say, you should be in these 5 wards. Out of these 5 wards, are these 12 buildings available, but only 7 of these buildings have availability. You should be going there because for your age group, they want bars, they want restaurants, they want 2 subway lines, and they need proximity to living, and these are the apartment complexes within this radius where 15 minutes from work they can get from 2 to 3 subway stops, and these are the rent profile of these apartment buildings that you can actually put your staff into. But it's all centered around quality of life. Lifestyle of that pool of employees you want to attract needs all these amenities, and you can't get that in a suburban office park.
You can't get the AI broker to take you out for lunch, though.
No, that
I'll take you out for lunch.
No golf. But that was impressive. I thought, wow. So I was worried about, I told my HR, I said, we have to rethink how many analysts we need per year. Or then I was thinking, actually, I think the next generation, slightly senior, but not senior enough with enough experience to teach AI yet, will be, they have to relearn AI. Otherwise, the new kids coming in who are AI native will actually be able to displace the associates very, very quickly.
Yeah.
So that may change your people ratios and it may change the type of people you hire, but it's probably not going to change where you're located, right? You're still going to need to be in neighborhoods where you have all of that around you.
Yeah, quality of life, right? Until it gets to a day where we don't even go to a hotel, we go into a room with 4 blank walls and you put on an AR goggle and that dictates whether you're in Bora Bora, you're Hawaii, or whether you're in Tokyo, right? If that day comes, then it's Matrix.
Well, AI is making the cost of labor cheaper, right? So will we need this office space?
Yeah, I think that the general view at least is that the economies are still growing. I think interesting in Asia is people are still coming to cities, so the urbanization is happening. So people are needing to find locations to live and work. So there is still demand. I mean, again, it's not just about people; it's about the propensity to pay. And I think Singapore is a good example. I've heard so many times that there's only so many population growth and there's only so many employment passes. But that's not really the issue. The issue is how much can someone afford to pay to have their office in the location that they want to be in, and that's really what's created the logistics. I think a misnomer that you can create endless supplies of logistics and keep going west in a lot of markets, but that has not proven to be true. That logistics companies will pay for delivery time, they'll pay for proximity to catchment. So location around infrastructure is everything, and I think it's the same for office as well.
Well, we've got 3 minutes left on the clock, so maybe under a minute each. What is one key investing theme that the people in this room cannot afford to ignore? We'll start with Kishore.
I'd go back to where I started, which is, I think, debt and a broadening out of how we look at real estate and look at real estate not just in owning physical form, but all parts of the cap structure. And I would also say broadening out what we define as real estate, right? Data centers, many companies define it as infrastructure. Is an airport real estate? Is a port real estate? I mean, all of that physically sits on land. And if you're doing an office building or a shopping mall where you know how to sort of build and develop and then stabilize an asset, why is that any different in many ways from an operating asset from a hotel to an airport, or for that matter, a renewables power project, right, which needs physical real estate to kind of make that possible. So I'd say other asset classes of real estate, broadening out beyond what we're used to, and then playing in the debt part of the cap structure.
I would say something that's actionable for any APAC investor in this room: watch Hong Kong next 18 months. Right? It's China policy from China, investors' appetite from around the world. It's at an unusually cyclical low, and fundamental drivers are all there. All the long-term investment in terms of infrastructure, Greater Bay Area integration, stock market revival, China catching up to the world on tech and AI. All of that is going to put Hong Kong right in the center of a bullseye. And you can action it from retail investors through publicly traded real estate stock to REITs to actually buying an apartment or investing in a building and so on and so forth.
I think we have to be clear whether we are buying the real estate for long-term dividend yield or for sale, where you can make a kind of a capital turnover quite fast. So in some of these, depending on which sector you're looking at, and then you can look at countries where residential will always be something top of the mind that every young person wants to own, or people who already own the asset wants to upgrade. And in terms of dividend, for example, you want regular dividend, then probably the logistics sector, or as what Kishore has said, the debt sector looks interesting. It's either the mezzanine side, the senior lending side. These all look interesting. A word of caution, though, is everyone is going into that sector. So when everyone goes into that sector, that's also when we have to be extra cautious.
Yeah, for me, I think in Asia Pacific at least, it's about sort of playing the growing middle class, and the ways to do that is certainly the retail sector. I think experience retail, definitely hotels, destination, and then the one sector that will not be as impacted, and if anything will benefit from AI, is the living sector. So, and just with aging populations across the world, and the broadening out of that living sector, and to be honest, a bit of between hotels and service departments and co-living and student housing and senior living, there is this blending of accommodation that is required in both flexibility, but also because of housing affordability. So for me, it's the living sector. I just think that it provides the reliability of income that pensions and insurance companies need, but there's just this huge demand base as well.
Well, if you've appreciated the insights, I'm sorry we're out of time. So can we get a round of applause for our panelists, please? Kishore, Goodwin, Shui Ling, Stewart, thank you.
Thank you.